Tariffs just quietly took $2,800 out of the average American household. And most people have absolutely no idea this is happening yet. The University of Michigan Consumer Sentiment Index just crashed to 50.8. That reading, recorded in April 2025, is the lowest in 74 years. Not since 1952 has America's economic confidence fallen this dangerously low. This is lower than the fear Americans felt during the 2008 crash. It is lower than the economic terror of the COVID-19 pandemic. Americans actually felt more confident during the Cuban Missile Crisis than today. That comparison alone should stop every American dead in their tracks. If this channel is adding value, subscribe to Finance Insight right now. Hit the notification bell, never miss another critical financial update again. Now back to the numbers, because what they reveal is deeply unsettling. Understanding exactly what this index measures is critically important context right now. The University of Michigan has tracked consumer sentiment since the year 1952. Every single month, they survey roughly 500 American households across the country. They ask about personal finances, business conditions, and the economic outlook ahead. The results become a single score that reflects the national economic mood. A reading above 80 means Americans are feeling good about their finances. A reading below 60 historically signals serious economic trouble is approaching fast. America just printed 50.8, a reading that is simply catastrophic by comparison. This index last hit these depths during the Korean War era entirely. America was at war, yet people still felt more hopeful back then. Think about what that says about the current state of American confidence. This collapse did not happen overnight. There's a very specific reason. And that reason connects directly back to that $2,800 figure mentioned earlier. In April 2025, the United States implemented sweeping tariffs on imported goods. The Yale Budget Lab estimated these tariffs would cost households $2,800 annually. That is not a government estimate. That is an independent academic calculation. For the median American worker, $20,800 equals nearly 3 weeks of income. That money does not come back. It disappears into higher prices permanently. Americans felt this pressure immediately in grocery stores and at gas stations. Retailers like Walmart and Target began warning customers about incoming price increases. Apple signaled price increases across product lines as tariff costs escalated sharply. Ford temporarily paused exports of certain vehicles due to the tariff uncertainty. These are not small companies panicking. These are America's economic powerhouses reacting. When giants like these adjust, everyday Americans begin feeling the pain fast. But tariffs are only one piece of this much larger economic puzzle. The inflation expectations data right now is deeply alarming on its own. Short-term inflation expectations from the same survey surged to 6.7%. That is the highest short-term inflation expectation recorded since the year 1981. In 1981, the Fed raised rates to a crushing 20%. America was in genuine crisis with double-digit unemployment back in 1981. Today's 6.7% figure tells us Americans fear a painful crisis returning. Long-run inflation expectations are equally disturbing and cannot be dismissed right now. The 5-year inflation outlook from the same survey jumped to 4.4%. That is the highest long-run inflation expectation recorded since the year 1991. In 1991, the United States was fighting through a serious recession period. Americans then feared prices would never stabilize, and they had good reason. Federal Reserve officials are watching these inflation expectations with grave concern now. Here's why those expectations matter far more than most currently understand. When people expect prices to rise, they demand higher wages from employers. When wages rise, businesses then raise prices to cover higher labor costs. This cycle feeds itself until inflation becomes deeply embedded across the economy. Economists call this the wage price spiral, historically very difficult to stop. America lived through this spiral during the brutal stagflation era of 1970s. It took a decade of extraordinary pain to bring that inflation down. Now, those same dangerous expectations are beginning to form again, alarmingly so. Consumer spending drives nearly 70% of total United States economic output. That represents over $19 trillion in consumer spending power each single year. When confidence collapses, that enormous $19 trillion spending engine slows dramatically down. Families start cutting back on restaurants, vacations, new cars, and major purchases. Businesses then delay hiring plans and start preparing for painful layoffs instead. Layoffs increase unemployment, which then makes consumer confidence fall even further down. This becomes a self-reinforcing doom loop that is devastatingly difficult to escape. History shows this pattern destroyed confidence in 1974, 1980, and 2008. In every case, a sharp sentiment collapse was followed directly by recession. The Conference Board's confidence index is also now flashing serious warning signals. It fell to 92.9 in March 2025, lowest since January of 2021. Two major independent surveys are now telling exactly the same troubling story. American households are losing confidence at a speed that is truly unprecedented. The stock market has been responding to this collapsing confidence dramatically too. The S&P 500 shed over 10% in just a few weeks. The Nasdaq entered correction territory, sending retirement accounts tumbling across America fast. Millions of Americans watched their 401k balances shrink thousands of dollars overnight. This wealth effect is very real. When portfolios fall, people spend less. Goldman Sachs raised its 2025 recession probability to a striking 45%. JP Morgan put its recession odds at 60% for the year 2025. These are not fringe analysts. These are the world's largest financial institutions. When these giants start assigning 60% recession odds, pay close attention. The Federal Reserve now finds itself in an extraordinarily difficult policy position. Normally, a slowing economy demands interest rate cuts to stimulate growth quickly. Surging inflation expectations mean rate cuts would only pour fuel on fire. Economists call this condition stagflation, rising prices alongside stagnant or shrinking growth. Stagflation is simply the worst economic position any central bank can face. The Fed is trapped with absolutely no clean policy solution available now. Jerome Powell acknowledged the situation presents a uniquely difficult navigation for policymakers. That measured language from a Fed chairman is extremely significant and revealing. Central bankers are famously careful about their words, choosing each one deliberately. When Powell admits difficulty, the underlying reality is almost certainly far worse. The real pain is falling hardest on middle and lower income American families. These households carry virtually no savings buffer when economic conditions suddenly deteriorate. American credit card debt has surpassed $121 trillion, a record-breaking alarming figure. For families without savings, this $2,800 annual cost is genuinely catastrophic news. Credit card delinquency rates are now climbing toward post-2008 financial crisis levels. Roughly 37% of Americans cannot handle a basic $400 emergency expense. Many Americans are now struggling to even meet minimum credit card payments. This financial stress does not remain contained. It ripples outward across communities. Small businesses are typically the very first casualties when confidence collapses hard. Restaurant closures, retail shutdowns, and local business layoffs follow with devastating speed. Every single indicator, the data, the surveys, the banks, says one thing. Every single data point right now is clearly pointing towards serious danger. History does not lie, and right now history is being loudly ignored. The last time sentiment fell this dangerously low was a defining moment. America was still rebuilding from a devastating world war back in 1952. The economic scars of that era shaped an entire generation very deeply. Today's generation is now about to learn the same brutal economic lessons. But the mechanism driving this collapse is distinctly modern and entirely deliberate. Tariff policy has created a massive shock that markets were not expecting. The speed of this sentiment collapse is precisely what truly alarms economists. From February to April 2025, confidence dropped a staggering 19 full points. That kind of drop in just weeks is historically almost entirely unprecedented. Only the earliest months of COVID produced a comparable speed of drop. But COVID was a global health emergency that nobody saw arriving whatsoever. This collapse is happening because of a policy choice, not a disaster. That distinction matters enormously when thinking about what realistically comes next economically. Policy-driven downturns carry a unique feature that purely natural downturns do not. They are reversible only when policymakers respond swiftly and with true decisiveness. The longer uncertainty continues, the deeper the economic damage ultimately compounds itself. Business investment decisions are already freezing across multiple major critical American sectors. Capital expenditure plans require confidence, and confidence has now completely evaporated. Boeing, a major American exporter, is facing severe headwinds from retaliatory tariffs. China canceled aircraft orders from Boeing almost immediately after tariffs sharply escalated. American agricultural exports are now being very deliberately targeted by China specifically. American soybean farmers, corn growers, and pork producers are growing deeply alarmed. China purchased roughly $26 billion annually in American agricultural export products before. That market does not simply reappear once trade relationships get badly damaged. Brazil and Argentina have already started aggressively filling America's lost Chinese market. Once market share is permanently lost in global trade, recovery takes decades. The damage to American agricultural communities could genuinely be long-lasting and irreversible. Tariff policies were specifically designed to bring manufacturing back to America eventually, but factory construction realistically takes years, not merely weeks or several months. Companies cannot build new factories, while deep uncertainty about future policy remains. Intel, TSMC, and Samsung are all visibly slowing their American investment decisions. The promised manufacturing renaissance still remains a distant promise, not current reality. Meanwhile, American consumers are already paying higher prices right now, not later. The pain is entirely immediate, while any claimed benefit remains years away. The housing market is now showing serious and alarming cracks under pressure. Mortgage application volumes dropped significantly throughout the entire first quarter of 2025. Home builder sentiment fell sharply as buyer traffic quietly declined across markets. Higher tariff-driven prices for lumber and materials are hammering construction costs hard. New home prices are rising at the exact moment buyer confidence collapses. This is a genuine perfect storm for the entire American housing sector. Rental markets are equally stressed as Americans delay every major purchase decision. Shelter costs represent the single largest monthly expense for most American households. When housing becomes unaffordable, deep economic stress radiates outward into every community. The labor market is the very last major economic pillar holding firm. Unemployment sits relatively contained near 4.2% as of early 2025 data, but leading indicators strongly suggest this labor resilience may not last long. Initial jobless claims have been quietly trending upward over multiple recent weeks. Tech sector layoffs have already resumed with many tens of thousands displaced. Meta, Microsoft, and Salesforce each announced very significant workforce reductions during 2025. These companies represent the absolute highest paying jobs across the entire American economy. When high-income workers lose jobs, luxury spending collapses with truly stunning speed. Luxury retail, high-end restaurants, and premium travel all suffer immediately and dramatically. The painful ripple effect flows from the top of income brackets downward. The NFIB Small Business Sentiment Survey fell significantly during early 2025 months. Small businesses employ nearly half of all private sector workers across America. When business owners lose confidence, new hiring freezes arrive with alarming immediacy. Hiring freezes turn rapidly into layoffs when revenues consistently disappoint business owners. That sequence has already started playing out visibly in towns across America. Real-time retail sales data is clearly reflecting this broad consumer pullback nationwide. Department store traffic is declining noticeably compared to the same prior period. Discretionary spending on clothing, electronics, and dining out is now contracting quickly. Only essential grocery and utility spending has remained even somewhat relatively firm. This spending compression pattern has historically always preceded a broader economic contraction. The global economic community is now watching America's situation with deep alarm. The International Monetary Fund downgraded its 2025 United States economic growth forecast. The IMF projects 2025 U.S. growth slowing to a dangerous 1.8%. That figure sits dangerously close to a technical recession growth threshold. Europe, Canada, and Asia are now actively preparing retaliatory economic contingency plans. Canada swiftly imposed $30 billion in direct retaliatory tariffs on American goods. The European Union developed a targeted list of vulnerable American export products. When major trading partners retaliate, American exporters suffer alongside regular import-buying consumers. This creates a punishing two-sided squeeze, compressing the entire American economic engine. The bond market is simultaneously sending deeply troubling and very uncomfortable signals. The 10-year Treasury yield briefly and alarmingly spiked above 4.5%. Rising yields signal global investors demanding substantially higher risk premiums for America. America's Treasury bonds have historically been the entire world's single safest asset. When Treasuries themselves face selling pressure, that signals deeply profound global unease. The dollar weakened against major world currencies throughout this entire turbulent period. Dollar weakness makes imports even more expensive for financially strained American consumers. This is yet another inflation pressure hitting at the very worst moment. The Federal Reserve's next May 2025 meeting carries extraordinary weight and pressure. Markets are watching every Fed word with unusually high intensity and anxiety. Interest rate cuts risk signaling economic weakness and fueling the dollar's decline. Rate hikes aimed at cooling inflation expectations would crush remaining economic growth. The Fed is navigating a dangerous trap with no clear viable exit. This environment is exactly where even small economic policy errors become catastrophic. The 1970s stagflation crisis broke only through years of enormous economic sacrifice. Unemployment was allowed to surge above 10% to crush that inflation. Millions of Americans lost their jobs, homes, and savings during that correction. If this trajectory holds, America could face those very same painful choices. What should everyday Americans do right now to protect their financial futures? First, build an emergency cash fund covering at least 6 full months. Second, attack high-interest credit card debt as quickly and aggressively as possible. Third, review investment portfolios carefully for excessive concentration in any vulnerable sectors. Fourth, avoid major discretionary purchases that can reasonably be safely postponed now. This is not a drill. The economic warning signs are absolutely everywhere. If Finance Insight is adding value, subscribe and hit the notification bell. Drop your biggest economic fear in the comments below. Let's talk openly.